Helen, when a couple decides to buy together, they expect their budget to double. But it is not always that simple. How does applying as a duo actually impact borrowing power, especially if one partner has debt?
A good question. A lot of people think that the more people on the mortgage application, the better. That is not correct.
Okay.
Today, I want to talk about the misconception of having more people on an application meaning it's a better thing, because usually it's not. So we will take a couple as an example. I will just give a simple example. Let's say you have husband and wife, and the husband has good income, but he has bad credit. For whatever reason has passed, he had bad credit and it's still showing up on his credit bureau, and he still has some missed payments. His credit score is low, but he's very well producing in income for the household. Let's say the wife has lower income, but she's never had bad debt in her life. She's got perfect credit score, but her income is low. What do you do in that situation? Do you use both, or do you use one, or do you use the other? In that scenario, we look at both people and we look at how much can the wife afford on her own? How much can they afford together? And does the husband qualify with a regular bank or a regular monoline mortgage lender because of his credit? He might not qualify for a regular type of mortgage. And if he does not, then he will need significantly higher down payments through alternative lending. So those are the things that I personally would look at. Another thing that I would look at is adding perhaps somebody else. If they have a family member or a parent or a grandparent who wants to help them buy their first home, we could look at adding that person to strengthen the application. But in this scenario, what I would do is, if the husband qualifies with his bad credit and he has decent reason as to why his credit was bad, then I will use the wife as the main applicant, even though her income is lower, because her credit and her overall stability is better, and him as the co-borrower. So there is a difference in how we set that up, and that is how banks will look at it. You have the primary applicant, who's a stronger, you have the secondary one. You can have up to 4 people on the mortgage. So I have seen people buying as 2 couples. I've seen people buying it as husband, wife, and then parents, or even as children going on as co-signers. There is a difference between a co-signer and a guarantor, and I will get into that shortly. Let's do another scenario. Let's say the couple both have really good income, but they both have really bad debt to the point where they do not qualify for a regular mortgage. And they have to have significant down payment, but they don't have it, which I've seen a lot. It's very common, unfortunately, but it is. And so what do you do at that point? Do you tell them, no, you can't buy a house at this point? Do you work in your credit score? We could look at adding somebody to the mortgage to help them qualify, or have a significant down payment and how that would look. Or we could put together a plan for them to fix their credit in the shortest amount of time. That way they can actually qualify with me. And normally people don't have somebody that can co-sign for them, right? A mortgage is very expensive, and sometimes it doesn't work. If you think your mom or dad can co-sign for you, but they have their own mortgage, even though they have, debt, they still have a mortgage, they have other liabilities and low income, maybe they're retired. That doesn't necessarily mean that they're going to be a good co-signer for an application for a mortgage. In my mind, when I look at things like that, and a bank looks at it in a similar way, we look at a client as a liability and how much risk are they actually on a mortgage application. And so that is what I look at when I look at multiple applicants, whether they're family, whether they're husband or wife, or other spouses. Now, I do want to say the difference is between a co-applicant and a guarantor, which there is a huge misconception. Co-applicant is somebody who goes on the mortgage for whom we use their income to help you strengthen the file. We use their income, their debt. It strengthens the file. That person goes on the mortgage. They also go on land title. A guarantor is only there as somebody who needs to strengthen the application based on their overall scenario, but we do not need their income, nor do we use their income to qualify that person for the main applicant for the application. A good example of that is somebody who's very young, maybe somebody in their early 20s that the bank is not sure about because they don't have a big credit history. They just got their first job out of university, but they're making good money and they have their own savings for down payment. And then we use maybe a parent as a guarantor because we just need to have somebody guarantee and make the application look a little bit better. So that person does not go on the mortgage, but they are on title. They do go on land title. And there is a legal difference in that. You can talk to your lawyer about that difference. But no matter whether you're a co-applicant or a guarantor, you are taking the liability. You are taking that risk for that property. So as a guarantor, that mortgage is not going to show up on your credit bureau, right? So if your son or your child doesn't make the payments and they ruin their own credit, it's not going to ruin yours. However, you are still on land title. So if that property goes into foreclosure, you are liable for fixing and getting that sorted out. If the person is a co-applicant, that mortgage is on their credit file. So that means that if you try to get another mortgage in the future, this one is going to hinder you because it's a huge debt that you've taken on. Doesn't matter if you're a co-applicant or not, you're 100% liable. It's not 50-50. If you have 4 applicants, they're 100% responsible. Each person is 100% responsible. It's not a 25%, 25%, 25%. It's 100% on you. So if you come to me and you own a property with a sibling, for example, because you co-signed for your sibling and you're buying your first house, you're no longer qualified as a first-time home buyer because you're no longer a first-time home buyer. You're not qualified for the incentives. You're not qualified for the down payment assistance program because you've already co-signed and you're already on somebody else's mortgage. You're not a first-time home buyer. And so you lose all those aspects of being a first-time home buyer, but you're also 100% liable for that debt. So when I do your mortgage application or a bank does it, all your siblings' debt, all their credit, their property taxes, their mortgage, their heating costs, that is added, has 100% your debt to your mortgage application.
If you are finding this helpful, subscribe now to access our complete series of Canadian mortgages and master your home buying process.
So before you co-sign for somebody, talk to me.
That's very important because
Yes.
it sounds something simple at the beginning, but when you understand all of this, it's a very huge problem.
I think a lot of people have ruined their credit because of the misconceptions of co-signer versus guarantor. A lot of people think that they're co-signing and they're becoming a guarantor, but that is not the case. And I always want to let people know what the risks are. Even if it's their child, if it's their parent, grandparent, you always have to, this is the risk that you are taking, and whether they accept it or not, that is up to them, but you have to tell them what the actual risk is, because I think the misconception is, well, I'm only co-signing, so really it's not my debt, or I'm only co-signing, so it's only 50% of my debt. It's 100% your property and your fault if anything happens to those payments. It's the most common issue that I see that hinders people who are healthy financially. They have good income, good credit, and they think they're doing a really good job with everything. But then they go and co-sign for a family member who's not so financially savvy or who has good credit, and they never consider that their debt. But then when I pull their credit, I say, oh my gosh, well, your family member just missed 3 payments in a row. So that means you missed 3 payments in a row, because that's 100% your debt too. And that's 100% your monthly payments. When I look at your mortgage application, that's not their payments. I don't know who that person is. It's on your credit bureau. It's 100% your debt. It's 100% your responsibility. If it ruins their credit, it's going to ruin your credit too. So it's a very emotional topic because people want to help their family. But if that family is not helping you back, it hinders your financial situation, your livelihood, and it's all because people misunderstand the difference, right?
And I think that when you are planning to help your family, getting that legal figure in the contract is not the only way. Probably you can help them prior that decision, helping them to buy a business, to build a business, or to improve their financial situation. And I can see this topic as a strategic topic that we can work on with you. So that's very important for me because it's not like only a sign on a document. This is a strategy to build your wealth and to build your properties here in Canada, right?
Yeah, and also the topic of inheritance. So if you have children who you want to inherit your business or your property without paying crazy taxes on it or paying capital gains, that is again a whole other topic that we can have on how to do that. And maybe we could even bring in an accountant to have that discussion with us,
A
because
financial advisor, our friend Mike.
yeah, a financial advisor or an accountant or even a estate lawyer to tell you that, because the rules have changed over the past couple of years in Canada. And so for people to pass that wealth along that they've built in Canada, they have to do certain things now to do that, right? So for example, with real estate, if you own a property and you want to give it to one of your children because you're going to pass away soon, or you want to will it, you will it to your children, at this point in time, according to the current rules, you're better off to put your children on your deed right now. They don't have to go on the mortgage at this time, but they can be added to the deed, because if they're not added to the deed, they don't technically own the property. And then when they inherit the property, there's tax implications. If they resell it, there's capital gains implications. So really, if you think you're leaving your kids $1 million house, you could lose half of it.
Yes, I heard that, and especially for me, that I am not from here. I am from Mexico, and when you compare the rules are very different.
Yes.
In Mexico, we don't pay for any tax if you give something for your children or your mother, but here you do. So it's very important to have that strategy and to understand the conditions here in Canada in order to build wealth and in order to avoid many problems. That's why I consider very important to go with professionals like you in order to get an accurate assessment and in order to get information according to our needs, our specific needs. Is that correct?
I think that is correct. And it's not just a mortgage broker. If you're building wealth and you're thinking of long term, you want to talk to a good financial advisor, you want to talk to a good accountant and a good lawyer who understand your strategy and build that plan for you. And if you do it once, it does not mean that you don't have to do it again. In Canada, several years ago, rules had changed significantly. And so if you wrote a will more than 5 years ago, you should probably take a look at it and change it now and re-strategize with your people, because whatever was the rules 5 years ago are not the same today. And so every couple of years you want to do the reassessment. Maybe you don't keep up with, the federal regulations on taxes and inheritance, but your financial people definitely should.
Yes, I can see that. But I think that we are starting to do that with this space where professionals like you can share their knowledge and give us opportunity to learn and to see this as a strategy of wealth. Thank you so much, Helen. I appreciate your time and I hope to see you soon here again.
Thank you so much for having me. It was lovely.
Buying together is a game changer, but both of you need to be mortgage ready. Click here to review the 3 pillars lenders check before giving you the green light.